Yeah, we are looking really in the most basic terms for 4 items that will allow us to invest in a stock. One is we want a great business. A great business has a barrier to entry in it that has a sustainable competitive advantage that allows the company to earn above its cost of capital, not only for the next quarter or so, but for the extended period of time. And this is generally a patent, a technology, a brand, a government license, a distribution network, a network effect, being, scale advantage, something that gives a permanency to its supremacy in terms of financial returns. The next thing is we want to buy these things cheaply. We want to buy these things at a discount to what they're worth historically, what they're worth versus a peer group, versus their own financial returns. We want to buy things where there's upside to it. And then the third thing we look for is managements. We want to have managements that are stewards and are appropriate stewards of the company's capital that they're generating. It's great to have a high return business, but if you have a high return business and the management is wasting that capital with empire building, with hiring excess staff, with 3-hour lunches, with vacation homes in the balance sheet, and with allocating capital without a discipline towards looking at the returns that those investments make. It's a lot like cleaning your office and then arranging all your papers neatly on your desk, but then opening up the window on a windy day. So you can find these great companies, but all the returns are going to be wasted in the wind. And the last thing we look for is catalysts, something that will bring the market's attention to what we see. That we don't want to have what they call value traps, great businesses, but they never appreciate in the market. So this can be something that that'll bring the market's attention to the enterprise. This can be something like an acquisition, it can be something like a dividend, it can be a share buyback, it can be moving into a new geography, it can be a new product launch, it can be increased sell-side coverage, it can be increased interaction with the market, but something that'll help draw the market's attention to the inherent value that we see. In general, you need all 4 of them. If you have great businesses and great managers, those are the 2 best places to start. You want to be buying things cheaply, but if it's a good business over the longer term, if it's really a multi-year holding, whether you bought it at $3 or $4, generally 5 years later is not going to be the biggest issue. But understanding the businesses well, how they make money, the level of returns, the direction of returns, the sustainability of returns, and the way managements think and will allocate that capital, those are really the sine qua nons of this investment philosophy.